Welcome to Requity Insights, a channel dedicated to documenting our journey to 100 world-class communities.
Welcome to today's episode of Requity Insights. My name is Velez, and I'm joined by my co-host and the CEO of the Requity Group, Marma. Thanks for joining us again, Dylan.
Good to be here.
On today's show, we'll be discussing the current property insurance crisis in Florida. The state of Florida is facing a significant challenge as property insurance rates continue to soar, leaving property owners and businesses struggling to afford coverage. The insurance crisis is having a significant impact on the real estate market, particularly the commercial sector. Many commercial property owners are seeing their insurance premiums increase dramatically, while others are struggling to find coverage at all. This has made it more difficult for businesses and investors to acquire and manage commercial real estate properties in Florida. Dylan, can you start by explaining what Florida's property insurance crisis is and why it's affecting the real estate market in Florida?
Sure thing, Lewis. So insurance prices on certain assets in Florida have doubled since January. And some property that was once insurable has little to no options of being insured at all at this time. The property insurance crisis in Florida is mainly caused really by a combination of factors. One being increasing claims, just more frequent claims, and severity of claims due to natural disasters such as hurricanes and floods. And you're also seeing rising reinsurance costs and litigation expenses. So as a result, many insurance companies are either pulling out of Florida market or they're raising the rates significantly, which has made it much more difficult and expensive for property owners to be able to obtain reasonable levels of insurance coverage. So this in turn has created uncertainty and risk for real estate investors, as insurance costs are a major component of any property's operating expenses, and it can impact valuations and the investment returns that coincide with those valuations.
Dylan, how does the recently passed legislation seeking to address this issue facing Florida, what specific measures are included in this bill? Could you talk to us a little bit about that?
So the recent passed legislation in Florida includes several measures aimed at overhauling the state's property insurance system. This includes the creation of $1 billion reinsurance fund, which can help reduce the risk and insolvency for insurers and also lowers the cost for consumers. The bill also seeks to reduce litigation costs and increase the state's oversight of the insurance conducts following hurricanes and compel some customers to leave a state-created insurer. So as to how that impacts us in the near term, we're still not fully able to understand, but we'll see how it plays out.
That's great, Dylan. I guess on the other hand, what are some of the criticisms of the current proposal for overhauling the property insurance system here in Florida?
So critics of the current proposal, they argue that it does not do enough to provide immediate relief for the customers facing these large rate increases. They suggest that the legislation could be improved by including more measures to address the immediate needs of the consumers, such as a freeze on rate increases or additional funding for insurance subsidies.
How has this insurance crisis impacted TRG's acquisition of commercial real estate properties in Florida? Are there any specific challenges that you faced?
Yeah, so it's absolutely made a huge difference on the way that we're underwriting deals and the valuations that we're able to put on any of the assets that we're underwriting currently. And we'll take a look at the three different asset types that we keep a pulse on here in the Florida market, starting with multifamily real estate and then getting into manufactured housing and RV campgrounds. So multifamily, I think, has taken arguably the biggest hit out of the three because insurance is a much higher piece of their operating expenses, given you have more physical structures that you're having to insure. Yeah. So when you look at what's taken place, you've seen, when I moved here 2.5 years ago, we saw insurance rates anywhere between $750 to maybe $900 or $1,000 per unit per year, pretty consistently. And we've seen that $750 go up to $1,500 and the $1,000 go up to $2,000. And if you're in a flood zone, forget it, right? It's likely went up at an even faster pace. And it's not like this just happened gradually over 2.5 years, which still wouldn't be gradual, but this happened since January. This happened over the last 4 months, and the insurance increase rates that most people underwrote of 4% per year, whatever it might be, has expedited 5-10 years ahead of schedule, and no one saw this coming. So when you look at that level of increase, just think about $1,000 per unit per year in increase that you have on a multifamily asset. That means that if you value that at a 5 cap, we'll say, and again, not talking about where cap rates are right now, but Florida real estate has traded very often at 5 caps. That would be $20,000 of value wiped out, right? Just then and there, just from that $1,000 increase in your insurance. So if you went in and you bought a building for $100,000 a unit, you might have $30,000, $35,000, $40,000 in as your equity. I mean, that could be half of your equity wiped out, right there on the spot. So that's half the money you put into the deal wiped out due to these rising insurance costs, right? So again, and thankfully we've seen a lot of different rental rates going up, and it's been a somewhat favorable market up to this point. So hopefully you have some coverage there. But right now it's getting ugly, right? It's a big deal, and it's not something that anyone can ignore right now. And then now you look at that increased cost, and I think a lot of people are living in disbelief and maybe still have a sense of optimism, which we don't know yet if that's a false sense of optimism. But I think there's kind of two trains of thought. Some operators right now are looking at this and they're saying, well, it's going to pass. They have to figure out a solution. It just can't be true. We're going to go back to closer to yesterday's rates somehow. The state's got to step in, right? And we've seen some groups going out there and aggressively buying deals and self-insuring those deals. So they're just saying, we're going to just cover it until we figure out a better solution at closing. One, I think it's extremely difficult to get a lender on board with that. I think you're going to have to close cash more than likely to be able to get away with self-insuring, because lenders are usually, they're usually going to be conservative about that. And they're going to require insurance. And then two, I mean, there's a huge difference between being in the business of a multifamily investor and being an insurance company. So you're now acting like an insurance company, and you have 1/1000th of the data that these major insurance companies have, right? They have data from all across the entire country. So for us to try to play that game is really dangerous. And unless you own thousands and tens of thousands of doors that you can kind of spread out risk across, I think it's a really, really slippery slope to go down, right? So you're seeing that side. And then the other side of it, you're having a lot of investors that see this and they say, this is a real issue and we have to do something about this now. And they're going ahead and they're actually renewing their insurance policies early because they're worried that we're going to go up another 50% in another 6 months from now. So they're getting ahead of it and they're saying, okay, I'm going to be proactive, even though my costs are going to go up 50%. I'm just going to get ahead of it because I don't want them to go up 100%. So let's lock in a long-term policy with someone that is still offering us insurance before it gets even worse. Yeah. So that's what you're seeing on the multifamily side. And then on the mobile home and RV side, you're seeing certainly what we call the lot insurance, right, or the site insurance, which just is really insuring. You have your GL policy, and then you have the physical infrastructure that is accommodated with the sites, and then you have the business interruption insurance that is all usually accommodated with the lot or the site insurance. That has certainly went up to the tune of somewhere, maybe say around a similar percentage, I think, but it's usually a lower percentage of your total income. So ballpark, say it went from 175 a lot to 350 a lot or somewhere in that range, right? We're still, and a lot of this is up in the air, so don't hold me to these numbers. Talk to your insurance broker, but we're speaking off anecdotal experience and what we've seen on different deals that we've been either evaluating or that we currently own and operate. But we've seen a pretty similar percentaging, which is definitely making an impact, though it tends to be a lower percentage of total operating expenses or total income. So it hasn't made as big of an impact, but without a doubt, it has made an impact, and it will continue to make an impact on the valuation of MH and RV assets. And the big issue on the mobile home side is the insurability of park-owned homes. So park-owned home insurance has always been something that you're paying a premium for, because there's only usually some niche providers that will offer the POH insurance, and they see them as not super durable and not super wind resistant, and generally a little bit more administrative work to insure a bunch of park-owned homes. So usually you have to pay a little bit of a premium. But now we've recently been looking at deals where they say we just can't insure it at all. And they're just pulling back completely and you can't find any options, right? So a lot of the times you're ending up looking at the state program, and even then it's still not financially, it doesn't make any financial sense to consider the levels of the rate that they're trying to charge for insurance. You pretty much would say, well, I have to pay that. I might as well just be prepared to just fund and buy a new home when a storm does come, because it seems like it's gonna be a better option just doing it that way, right? So POH insurance in Florida is really risky, and I think that's going to be something that MH operators have to keep eyes on, and we're going to continue to kind of figure out more. But we operate along the coast of North Carolina, and we use a state fund there, and it's been a little bit more reasonably priced, I'd say, than where Florida is right now. So my hope is that the state will be able to get to a point where they offer a state fund that can offer some more reasonable options to be able to incentivize people to stay living along the coast, or even living in Orlando, Florida. You're seeing the same thing all across Florida right now. So we want to be able to see some kind of intervention to be able to help solve for that. But right now, it's all up in the air.
Wow, it's a lot to digest. I mean, 100% increase in 4 months is definitely a crisis by any stretch of the word, I think. What steps, Dylan, has TRG taken to mitigate the impact of this insurance crisis on the business?
Well, for us, I think the main thing is we are just being cautious right now on the acquisition front. The majority of our portfolio is out of state, though we live here. We have some smaller assets that we own within the state of Florida, though we have been aggressively underwriting a lot of deals to find our way in. We continue to be faced various hurdles such as this that make it harder and harder to be able to compete, to be able to get meaningful market share in the Florida market. But I would say, given that we're mostly looking at this from the standpoint of getting into new acquisitions in the state of Florida, we are really just speaking early and often to our insurance broker. As soon as we're looking at a deal, before we're putting in our LOI, we're making the phone call, talking to the insurance broker and seeing what can we do on this deal, and giving them ample time, because they're getting blown up right now by all their current customers with all these renewals going on. So we're just trying to get ahead of that. And secondly, we are really just trying to keep a pulse on the news as it comes, right? Right now we're in the middle of this, and we don't know what the end looks like, or if there's going to be an end in reasonable future, but we're just kind of keeping a pulse to see what the state announces, to see what the insurance brokers are going to have to say, and just taking it one day at a time.
Yeah, absolutely. How do you see the property insurance crisis evolving in the coming years?
I always say it's better to prepare, not to predict, and we really cannot foresee exactly where the insurance crisis is going to go. I think that there's, as mentioned, a potential for the state program to become a little bit more competitive and offer some more reasonable options for people to be able to insure, especially for those properties that are closer along the coast. I think that it will lower the prices people are willing to pay for real estate, and I think a lot of people are still living in denial of that, because they, just like when interest rates went up, everyone wanted last year's prices, and now insurance rates are going up, and that's just going to only add more fuel to the fire. I mean, I think it's going to get ugly out there for people that are sitting in high leverage floating rate loans right now. They were already dealing with enough pressure given where rates are right now, and the challenges of trying to get to either refinance or have a reasonable exit. And now when you add this on top of that, it's just going to really make it difficult for operators that are in that position right now. Hard to really predict what's going to happen from here, but I think just this, if there's ever been a time to be really cautious on your insurance assumptions and even your expense growth rates right now, this is a good time for it.
Yeah, absolutely. I guess finally, what advice would you give other real estate investors who are navigating this current insurance crisis here in Florida? What strategies or best practices should they keep in mind in addition to what you've already mentioned?
So it's mostly going to be a recap of a lot of the key items that we had mentioned here, but if you have existing assets in the market, highly encourage you to make sure you're talking to your insurance providers early about what renewals are going to look like, so that gives you an ample runway to start to shop for alternate solution. I also recommend that you're really upfront with any equity partners that you have backing you on the issues that are taking place. Right? If you're in the middle of a deal and you're fundraising, whether it be from accredited investors or from institutional capital, I think we've tried to just really be really upfront with this is a risk. There is a huge unknown here, and we are doing our best to try to, underwrite conservatively in this environment, but it's hard to tell where this is going to stop. So making sure that anyone that is taking risk of investing alongside you is aware of those risks, and they see things and they're on the same page with that. Or if you have deals you're asset managing, making sure you're proactive with letting them know that at renewal season there's going to be likely some issues with insurance from the standpoint of seeing the rates jump up. And on new deals, just make sure you're extra cautious, and that's pretty much all we can do right now.
Well, we hope that through this conversation, we can shed some light on this important topic and provide valuable information for anybody who's interested in the future of commercial real estate here in the state of Florida. If you have any questions or comments, please feel free to reach out to us. We've actually got a monthly newsletter that you could also check out on the comments below. Thank you guys for watching. And as always, don't forget to like, share, and subscribe, and we'll see you next time.
Thanks for tuning in to another episode of Requity Insights hosted by our team at the Requity Group. You can find recordings of all shows along with our opt-in form to set up a call and view future investment offerings on our company website, therequitygroup.com, also listed in the show notes.